crazy week so far, and Nasdaq is just in a full melt up mode, and it's pretty apparent that a lot of people are either very euphoric or very upset. Right? They're euphoric that they're in the market and it just keeps printing new all-time highs day after day, or they're upset because they're sidelined. So I feel like that's the general take as I scroll through social media. Now I know that's not the obviously the whole market, but certainly something that comes off as you scroll through the feed and you realize that either one, someone's super happy or super pissed.
Yeah, I'm definitely getting some FOMO vibes coming in here. Like that distance from Momo now is getting extremely big, and that typically is not a good sign. Historically, as we deviate away from Momo like this, there is a correction that happens. Now, is that correction going to be caused by the CPI print tomorrow? Who knows? It's possible. But I think that's what we should focus on for this podcast is CPI, like what is going to really happen there with that and how it's going to affect equities and how it's going to affect bonds. Uh,
Well,
what are
let's
your
start with
thoughts on? Yeah, go ahead. What are you gonna say?
let's let's start with equities, right? Like I know last podcast I made the statement that about exactly what you just said, right? Look, we're far from Momo. We're pretty deviated, right? So and that was I believe we recorded that pod on Thursday, or was it Wednesday? Or no, Friday,
No, it
right? So
was
we were
Friday.
we were
Yep.
we were pretty much here, right? We're at almost 500 on the Nasdaq, and I've been taking some water on that call the last couple of days, where the market's pretty much up again even further, right? So getting even more extended from the last podcast, and I just want to go back to say the most important thing that you guys should take away from what we say, and and just in general, is we do not short bullish trends, right? There's no there's no winning strategy shorting bullish trends from our perspective. So I just want to make that clear before we dive into the podcast. I did think the market would pull back a little bit. Maybe it does soon, but I do think that we are quite extended to the point where consolidation at a minimum is to be expected. Now, that doesn't mean I'm short. Doesn't mean I need the market to crash, right? That's not how our strategies work. I'm just saying, from a mean reverting perspective, we are quite extended from what we normally trend at.
It's also
So,
really important to know for people that are looking to short, just because it's too high is not a reason to short, and that's a very easy way to blow up accounts. That's why we created DDAP, which shows us the trends and helps us follow the trends and ride the waves. And just shorting purely based because it's too high is a very easy way to blow up an account. I would much rather buy here than short here, which I'm not doing either at this point. The members
right, but
know
I
what
get
our
your point.
positions
I get
are.
I get your point. Yeah.
But yeah, so let's run through some scenarios with CPI. So if CPI comes in at estimates, let's start with that. If CPI comes in at estimates, what do you think is going to happen to equities?
So let's first figure out what the estimates are, right? And to answer your question, right now, and this is not the Wall Street consensus, but it's pretty darn close. I would say with rounding, it's the same. So right now, the June estimate, which is we're going to get tomorrow morning, is 3.12% or 3.1% based on the street, right? So that's 3.1% for headline year over year. The last print was pretty much at 3.3 rounded up. So there's 20 basis points um of disinflation essentially priced in on the year over year print from the last print to the print that we're going to see tomorrow. So I think if we come in at estimates at 3.1, I don't know if the reaction is going to be very significant, right? Because I mean, this type of move that we had in the market lately here, this rapid, we're talking about pretty much up every single day this week so far into the print. And I mean, we're up every single day of every single um trading day this month. I believe the Nasdaq is green. So July has been a green month every single day, right? So I mean, now we're going into some type of event where people could be, for whatever reason, caught off sides. I feel like maybe the consensus was that CPI would be soft, so they piled in ahead, and maybe we come in at 3.2, and everyone's a little scared, and there's some sort of reaction to that, right? I don't think we're coming in above 3 points. I'd be surprised if we came in over the prior, right, which is 3.3. If estimates are 3.1, we've seen a good contraction over the last year in inflation volatility, right? So essentially, volatility and inflation has come under control to the point where it doesn't deviate significantly from the estimates, or basically what consensus is expecting it to come in at. So I think as long as we're in that even at 3.2, I don't think it's a severe thing. Maybe the market sells off a little bit. Maybe we can get that mid vamp on the Nasdaq, um, or whatnot. But I don't think, again, we're not the CPI. I don't believe is at this point is going to be crashing the markets unless it's above unless we start to see a trend above priors, which again would require us to come in over 3 point.
Okay, so let's run through the next scenario. Um, what's going to happen if we actually do see a large contraction in CPI and we are quite below the estimates?
Right. So, I mean, again, Cleveland has the month over month at 7 basis points, right, for inflation. So you're essentially saying negative, right? You're talking about. I would assume in your scenario we're under 3. We put like 2.9, right?
Yeah.
And in that case, with real GDP and overall GDP estimates where they are at the moment, I think it opens up the door for some sort of squeeze, and that's a simultaneous squeeze, right, across equities and bonds. I
Well,
think
don't you
bonds
think
get.
equities are going to be scared and start pricing in a deflationary regime once that happens?
Hmm. I mean, yeah, like that's obviously a. So when we talk about how the market takes these prints, obviously there's a lot of nuance. Like we're basically playing forecaster right now, but like how the market absorbs that when it prints is really the key. But I know what you're saying. Like, is this inflation really accelerating to the point where people start getting scared for inflation? And I don't think, I really just don't believe that a 2.9% print um, would instill a bunch of fear, at least because again, we're talking about 20 basis point deviation. I mean, it's a steep deviation. I think a 3% would be wow. A 2.9% would be like, okay. Like if we started printing, like if we flipped a print at like 2.6, right? I think at that point people are like, oh gosh, what's going on? Right. And I also think there's also, it's going to be hard to really roll the um the prints down because we already know, and I want to bring up a chart here in a second. But before I bring that chart up, let's bring up the regular headline CPI inflation composition chart, and you can see that we're pretty much snagged here by services, right? Like services is what is holding up inflation, meaning, and isolating this down further, rents and shelter are holding up the inflation print. And if you can see here, the last print, core goods were negative. Energy was, we're talking barely a contributor. So core goods actually was a detractor from the overall inflation print, with energy being a slight contributor and food being a slight contributor. So if we want to like look at this on another level, there's an account, I'm sure you guys follow this person, Wabafo. He is the starfish, and he put a great chart up earlier before we recorded this podcast, and I thought was worth mentioning. If you take a look at inflation and we remove shelter, just shelter. I don't want to remove food, just want to remove shelter to give you an idea of where inflation is right now. It's at 2.1%. So we're 10 basis points over the Fed's target if we remove shelter. Now, obviously, we can't use this as a realistic representation of inflation, right? Because you can't just discredit shelter. A lot of these people, they like to, and I'm not speaking about this account here, but a lot of the macro accounts like to compute some weird or obscure inflation index, if it's super core, whatever it may be, and claim that that's like that's what we should be paying attention to. the end of the day, headline is the most important. But this is just giving you some context to the situation that if in your statement, inflation were to come in at 2.9, right? What you were saying, cooler than expected. I believe we would have to see some material service sector slowdown there to get us to that point, right? Because if either that or some extreme deviation in core goods and food, because energy we know is not really falling apart at the moment, right? So we know energy is not going to be such a drag on CPI, at least at this point, right? And that leaves core goods and energy, core goods and food and core goods, food and services, excuse me, to really alter CPI. And I don't think that you're going to see such a huge upfront hit in services, specifically shelter. But we'll see. Maybe there's some considerable decline. I mean, you can see here in the last fall, right, how shelter pretty much fell marginally and was more like a gradual drop, not so much a crash, right? And I think maybe we hit this period of slowing disinflation or somewhat of a minor, we're talking real minor reacceleration in services inflation. And maybe we start getting back in that stair stepper at some point on the way back down. So I don't know if it's going to be such a straight fall, but I do think inflation printing at 3.1, possibly 3, would be overall bullish for equities and
Well,
bonds.
at this point, does it even really matter what core services does as long as it doesn't get go higher? Even if it kind of stays in this area and drops, even if it drops quickly, that doesn't seem like it's going to be bearish at all.
No, so the real problem I think is what we have to pay attention to is the other contributors, right? Because core services has a long ways to go before it's flat, right? I mean, we can just see here it's snagged up and it's going to take a while to
Yeah,
decay.
so we
But it's
don't want to see those other ones that have come under control start rising again.
right, or decaying. Like we don't want to see you see here what happened with energy in 23. Like we don't want to see that start to happen with core goods and food and etc. Right? We want to see somewhat of a stable or some sort of stability here. Now it would be nice to see energy come in a bit, right? And we've spoken about this before. There's a difference between energy coming in or quote unquote pulling back and crashing, right? Energy coming in is a positive sign that things are finding stable ground or stable footing. Energy crashing is you start getting demand concerns, right? So I think what we're going to want to see is just a gradual shift here and ease lower in what we pretty much a continuation of the disinflation that we were seeing a year and a half ago, and just really start to see it be absorbed more in the shelter and service and core services, therefore giving us overall lower and lower headline prints, which would again be well accepted by pretty much everyone, and maybe open up the Fed's mindset for actually, or at least finally, bringing rate cuts to the table. I mean, we've been speaking about the Fed cutting rates for a while now, man. Like it's been going on. I think we started making this claim that the rate cuts should have already started in the Q4, the end of 2023, early 2024, right? And we're 7 months into 2024, and we still haven't seen a single rate cut.
Yeah, and I
So
think if we do see a decay in core goods, food and energy as well, if we start seeing a decay in this next print, then maybe that's going to be what the Fed needed to see. Because I doubt that they're waiting for core services to come down before making their
they're
move. That wouldn't make sense.
no, they're not. Let's be honest. The Fed, as much as everyone wants to claim they are, the Fed's not retarded. Okay, the
Yeah.
Fed knows what's going on.
If
They
they're
see.
seeing like these other components really start to decay, they're gonna do something about it. And I think if we do see that tomorrow, that's gonna start pricing in some more cuts in the Fed funds futures, and that's gonna affect the bond trade quite a bit.
Yeah, and
I think bonds here are more susceptible to volatility from this print tomorrow than equities are.
very likely because, and we'll go over that in a second in terms of what we're seeing in the overall interest rate space. But I do want to go touch up before we dive into the rest of this podcast on interest rates. I just want to touch on Bitcoin because I know that, and I don't mean to jump around, but I know that a lot of people are just they're confused because this is the one of the signals that we've released publicly. Our signals from our model, from our Bitcoin model, we released this one publicly after we exited, but we still made this. We've been pretty transparent with our positioning on it at the moment. We are not in Bitcoin at the moment. We are cashed on the sideline. And I think a lot of people are kind of taken back, maybe even upset on that positioning, right? Because they see, oh, they were risk on bullish new highs this entire year, pretty much. I mean, from 43K, slightly after the ETF, a few days following the ETF approval, or a week or so, that's when we really started pounding the table in 2024, and we are now sidelined. And I think people might feel some sort of way. I know Bitcoin has has a large audience that has a love/hate relationship where either people, despise it or they really just don't want to let it go. And I think that that's one of the key things in this space is being able to be nimble, right? Like just sitting around and saying, okay, trends flip bearish, conditions have changed. It's time to cash out for the time being. And we did so at 63K. We averaged out, our sales averaged out at 63,000. So price is down. Now, I'd love to get back into this, but obviously you follow our models, our requirements to get back in. We need to see some certain boxes checked, and then we'll gladly buy back in. We're not out indefinitely, but I just do think that it's something that you have to take a grain of salt with when you hear us say, new market high, whatever it may be. If it's Bitcoin, if it's equity, if it's bonds, it comes down to the conditions at hand. If those conditions shift, then our positioning is going to shift. No hard feelings. We got to keep the ball moving. And I think that's just something that in this space is just so ignored because people fall in love with things, right? They fall in love with their biases and they just can't let go of anything. So I just want to make that clear that we're out of Bitcoin. We hope it rebounds and puts some more bullish price action on the chart so we can get back in. But until then, this is sidelined. So let's go back into the rate talk though, because I feel like that's where we're going to wrap up this podcast.
Yeah, let's get into the bonds.
So what I did on this chart here, I'm showing a 30-year chart, and a lot of people are looking at this yield, and I want to just see if I can hide all the drawings quickly. Okay, so they look at this and they're like, okay, this is a 40 plus year downtrend, right? This is going to change, meaning like, oh, we're reaching a new fulcrum where now we're going to be in an uptrending rate environment, right? And I think that there's a caveat here. A lot of people just don't want to believe or just don't understand, right? So before we came into this, call it period of post GFC period, there was essentially no bounds to which the Fed was holding inflation to. They kind of just chased it up and chased it down, essentially, right? They tried to find a medium. It was basically, essentially, they were just testing and trying to control the economy one way or the other, right? And there was a lot of interest rate volatility. It was the volatility interest rates were high. I mean, you could see these pushes and pulls, especially going back, early 2000s, these wide ranges. And we saw that again in the last couple of years, obviously, with the Fed coming up from zero, right? They raised from 0 to 500 basis points. There's going to be interest rate volatility when they do that. But I think the important part of the caveat here that not many people are paying attention to is the thing that everyone mocks the most about the Fed, the mocked 2% inflation target. Now, I'm going to enable some drawings here for a second. And what you're going to see here is in 2012, Bernanke establishes the 2% inflation target, okay? And what you'll notice is after 2012, we don't really go too high. We don't really go too low outside of COVID. We almost deviate around 3%. And remember, this is duration, right? This is 30 years. So even though inflation is projected to be controlled at 2%, it's not going to be 2% consistently. There's going to be above and below period averages in that complex of 30 years. And what you'll notice here is if we draw a linear regression line from when the target was announced to where we are now, you'll see that we have a linear regression, or excuse me, a regression line that steadies around 3% right now. If we were to look at where we are, about 3%, and standard deviation bands up around the 3.8 to 2.25. So in that range, right? We're out of bounds at the moment, right? The environment, the Fed alone is restrictive. We can argue how restrictive. They're in a restrictive state, right? We know rate cuts are coming at some point. We know that the economy is slowing or softening, right? And ultimately, the idea here is that rates should reset in the cycle towards their norm if inflation can be controlled, right? Because the only reason rates are going to trade this high it comes down to two things. Number one, unpredictable inflation, right? Or above average inflation, which we've been seeing, which is why rates are where they are. And the second factor would be deficit spending, right? Would be the idea that, okay, the government is going to be issuing more than it's bringing in. So it's going to have a deficit, spending more than they're making. And they're going to have to press the bond market to raise funds, right? So I think that those are really the only two factors that matter in the bond market. And number one, everyone's looking at the inflation where we are right now and saying, oh my God, but we just went over it. Like, we know that we go back to this chart here. We're talking 2.1 less shelter, right? 2.1% less shelter. So we know there's some distortion in these figures. This is not going to be sustained like this for a very long time. We believe at Market Radar that we're going to see a gradual or a persistent, I should say, flow of disinflation. Even if it might be choppy like we saw here in the last couple of months, it should continue and there should be some sort of forward path of disinflation. So that perspective of inflation remaining above average for way too long, well, we're at 3.2 right now. If we come in at 3.1 tomorrow, we're 110 basis points over the Fed's target, right? And if we take a look at the inflation rate, we're 3.1 is pretty much 20 basis points over the 2018 peak. Talk about control. Like, we've come in to ranges that we've just seen pre-COVID, right? Like, it's not like we're just getting back to what we were seeing at the peak of the GFC, before the GFC. Like, we're in bounds of we're in reach of where we were pre-COVID, right? So I think that to some degree, we have to start looking at the picture and saying, like, inflation isn't the problem anymore. And with that said, we go back to bond yields. Okay, if inflation is not the problem, well, then deficit spending, right? Successive spending is good. They're going to have to borrow from somewhere. They're going to issue long-term debt, and they're going to really just push rates up. And obviously, there's two factors here. Number one, the reason bond rates are this high is not just because there's an expectation that they're going to just issue trillions of dollars, right? It's the Fed is holding rates up. There's an artificial floor along the curve as we look out in time. If the Fed were to bring rates down as expected, I don't expect the bond market on the long end to really have a significant move lower, right? Because the bond market is essentially pricing in for 5 cuts in the next year. The the alpha here that's made is when the Fed has to cut more than the bond market's pricing in at the time that you were to say to buy bonds, right? If you buy bonds today, you're betting that there's going to be more rate cuts in the next 12 to 18 months than the market is currently pricing in. That's where the alpha is made. Now, I do think that if inflation's not an issue and we look at the deficits, we're at 6%. We're well off the COVID lows, right? And we're also in an environment where we could see a presidential shift in 2024 in the election later this year, or party shift, I want to say, right? And right now it's obviously Donald Trump versus Joe Biden. And I think that the consensus at the moment is Donald Trump may blow out the deficit because he may be spending egregiously, especially if the Republicans control, if it's a single party control across Congress, right? And I want to take a step back there and say that ultimately Donald Trump wasn't as bearish wasn't as bad for the deficit as many people make it out to be. I think his propositions sound crazy, and I don't know how many of them do get executed. And ultimately, the ultimate meaning behind what I'm saying is essentially, if it wasn't for COVID, if you removed COVID from the situation from Trump's presidency, the deficit averages, I believe, 3.9%. We're at 6. So we're nearly, if you do the math, we're nearly 50% lower now than we were when Trump was in office. And there was a time in there when he did have single party control, whatever it may be. So you can claim Trump's going to blow the deficit out, but he didn't before. And now if you're like, oh, but COVID, right? Take a step back. I mean, you can't make COVID the base case. Like we have to spend to fix to basically stabilize the economy.
Yeah, I mean,
right?
like the whole world shut down. That's not really
Right.
like obviously you're
So
gonna have insane spending in that kind of situation.
for sure, right? So now where I want to bring this back to in our discussion, right, is if inflation is under control, like we just said, like it might seem high right now, but in the long run, disinflation should continue. And the deficit likely is going to remain the same, possibly decrease. And now the issue there again with the deficit is, oh, we're going to be spending an enormous amount on interest. Well, don't you think the Fed is going to be reducing rates? And if they do, they're going to be more than what everyone's expecting, right? Realistically. Like
Yeah, I mean that's how it always happens. They always
right.
get into a situation where they need to panic cut. That's what they always do to themselves, and I think that's what we're heading towards. There isn't really anything coming out just yet that's putting them in that position, but I think as time goes on, we are already seeing growth weakening in different areas, and it becomes very instant at some point. There's going to be an inflection point, and growth is going to accelerate downward if we don't get a rebound. Obviously, a rebound in growth is possible, but if that doesn't happen and we stay restrictive, it's going to accelerate very quickly, and they're going to put themselves in that panic cut situation. I think that's what is going to bring us to the point where what the Fed funds futures are pricing in right now, which is or just under 4 cuts for the next year, that's going to accelerate. And that's what's going to bring us possibly back to that 3% range on your chart there.
Right. Well, also just remember, right? So the deficit there is something that everyone wants to talk about with bonds. Well, if you check the market's expectation of who's going to become the next president, it's apparent Trump's winning right now, right? Like it's apparent in the polls. And I want to be as apolitical as possible. We're not trying to pick a winner here. I'm just saying the market is defining Trump to be leading at the moment, right? The betting market. Now, if the market was that scared about a Trump deficit, bonds would be trading higher. I mean, yields would be trading higher already, right? If the market was that shocked that of some sort of Trump deficit, it would start moving. If Trump was that negative for the deficit, I don't believe Trump's going to be as, again, bearish for the deficit as a lot of people make him out to be. But we can discuss that later because it's not really so pertinent in terms of the move in rates, right? Because if inflation's under control and even the deficit is somewhat controlled, right? What's going to happen here is bond yields are going to end up in a situation where they're going to trade back towards their average or back towards their point of 2% inflation. Meaning, if you think bond yields are going to trade 4% plus over the next 10 years, call it maybe in 5 years, right? You're betting that the Fed is not going to be able to get inflation under control anytime soon, right?
Right.
So what you're saying is the 2% target's not going to be met again. I believe that's nonsense. I believe the Fed actually may run into an issue, maybe not right now, but there's going to be a recession at some point where we may be sitting on this podcast wondering if the Fed's going to go to zero. Okay? Like there's going to be a point where inflation is going to go down. Maybe we need the recession to really break the inflation's back, but ultimately The 2% target is not being lifted. There's too much, it's been too cemented in politics at the moment. Something drastic would have to happen. Meaning, for the 2% target to be lifted, I believe we would have to go into a recession at 2%. Economically, or doesn't make any sense how this would happen, but I believe that the only way the Fed is going to work their way out of a 2% target is if recessions are occurring at or slightly below the 2% target, where if they were to get there, the economy wouldn't be able to be sustainable, right? That's the only point I think the Fed would lift that target. So I think the 2% target's here it's going to be here for a while. And therefore, I do think that at some point, rates need to mean revert lower, given we see inflation fix itself and the Fed brings rates in. I don't think the deficit is really a big driver, but I know people want to hear about it, especially with duration. These long-term bonds, people are so concerned about Yellen dumping duration, or whoever the Treasury secretary is at the time of a discussion, dumping duration on their head and saying, oh, yields have to go up because no one's going to buy the debt. So I just wanted to mention that. But ultimately, I do think that, we're not in a position where inflation should reaccelerate from here materially at this point, right? Therefore, bond yields are at what I would consider an apex. Like, they have much more downside risk than upside risk at this point.
Yeah,
And I think
that's where the alpha is.
Right. And obviously our models are going to, pick up on a lot of these things and take into account the current macro situation and execute accordingly. But I just wanted to make this podcast dedicated to bonds because I know a lot of people are probably looking at CPI tomorrow. What does it mean? Stocks versus bonds. This is stocks over bonds or bonds over stocks. But obviously our models will tell you that. But what I will tell you is it is in fact growth over inflation, and it has been for some time now. So I believe that's going to be the case again for the foreseeable future, unless we start to see some material movements in the inflation components, signaling that, look, the outlook is changing. Until we see that, disinflation should pretty much continue, albeit some bumps along the way. But growth is the prize at this point. If that starts losing footing and breaking down, then I think rate cuts really do start picking up in a stiff fashion. So I want to wrap the podcast up there, though. Thanks, guys, for listening. It was a great conversation, and we'll do this again next week.